you think about building an investment portfolio, most people's minds go straight to stocks and shares. But there's another type of investment that plays a crucial role in many portfolios and that most people know surprisingly little about: bonds. In fact, the global bond market is worth well over $100 trillion, making it actually larger than the global stock market. And yet, for most beginners, bonds remain one of the most misunderstood corners of investing. So today, we're going to change that. Hello, I'm Brian, and I'm here with Moneyfarm to give you a beginner's guide to bonds, what they are, why investors use them, and how you could actually go about investing in them. So, let's dive in. Okay, now let's start at the beginning. What actually is a bond? Well, a bond is a type of investment, but it works very differently from buying shares in a company. When you buy shares, you're taking an ownership stake in a business, and your return depends on how well that business performs. With a bond, it's different. You're not buying a piece of a company, you're lending money to one, or even to a government. Think of it like this. When a company or government needs to raise money, one of the ways they can do it is by borrowing from investors. A bond is essentially the formal agreement that sets out the terms of that loan, how long the money is borrowed for, and what the borrower will pay in return. And what do they pay in return? Well, they pay interest, which in the world of bonds is called a coupon. Essentially, if you buy a bond, you're paid a coupon at regular intervals over the life of a bond, and at the end of the agreed term, the borrower repays the original loan in full. You'll also sometimes hear bonds referred to as fixed income or fixed interest investments, which as names go actually tells you quite a lot, because you're lending money and in return you get a fixed stream of income. So unlike shares, where your return depends entirely on how the company performs, with a bond you know from day one what you'll be paid and for how long. And that predictability is actually one of the defining characteristics of bonds as an investment. And to understand why that matters and where bonds actually sit in the world of investing, it helps to look at this chart, which is called the risk-return trade-off. On the horizontal axis, you have risk, which increases as you move to the right. On the vertical axis, you have the expected return, which increases as you go up. In investing, every asset class sits somewhere along that diagonal. So you have cash sitting at the bottom left with low risk, but also the lowest expected return. Move up the diagonal and you get to bonds, with more return potential than cash, but still relatively low risk, at least when it comes to lending money to secure countries or big and well-established companies. Then come stocks, higher up again because they're more volatile, but they also offer stronger returns over the long run. And at the top right, riskier stuff like derivatives, private equity and crypto. Now, as you can see, bonds occupy that middle ground. So not the safest option and not the most performing. That said, for many investors, that's exactly the point. Now, bonds aren't all the same. They're issued by different borrowers, carry different levels of risk, and come with different time frames. So, let's walk through the main ones. First up, we have government bonds. These are issued by governments to help fund their spending, things like building infrastructure or covering the cost of public services. Because they're backed by a government, they're generally considered the lower risk end of the bond world. The logic is simple. Governments, in most cases, are seen as highly reliable borrowers. In the UK, government bonds are called gilts, but in other countries they have their own names, like US Treasuries, German Bunds, and so on. Then there are corporate bonds, so bonds issued by companies. These typically pay investors a higher rate of interest than government bonds because they come with more risk, as a company is simply more likely to default on a loan than a government. But within corporate bonds, there's an important distinction. Some are called investment grade, as they are issued by financially strong, well-established businesses with solid track records. Others are called high yield bonds, which, as the name suggests, offer high interest precisely because they carry higher risk. Perhaps because the company is smaller, newer, or already carrying significant debt. To help investors understand the risk level of any given bond, they're assigned a credit rating by specialist agencies. The highest is AAA. Anything rated BBB or above is considered investment grade. Below that, you're in high yield territory. And then there's the time frame. Some bonds are short duration, maturing in 1 to 3 years, whereas others run for 10, 20, or even 30 years. Now, regarding the time frame, what you need to know is that longer dated bonds tend to be more sensitive to changes in interest rates, which makes them somewhat riskier to hold. Now, apart from different types of bonds, it's also important to know what affects their prices. Well, first of all, bonds aren't just bought and held until maturity. They're also traded on markets, which means their prices can move around, and understanding what drives those price movements is one of the most important things to grasp about bonds. The most important relationship to understand is the one between bonds and interest rates. It works like this. When interest rates rise, newly issued bonds start offering higher returns, which makes existing bonds with their lower fixed rates look less attractive. The consequence is that fewer people want the lower interest bonds, so they sell them on the market, which causes their prices to fall. On the other hand, when interest rates fall, the opposite happens. So existing bonds paying higher interest suddenly look more appealing, and their prices rise. It sounds a bit counterintuitive at first, but think of it this way. If you're already holding a bond that pays 3% and new bonds are now offering 5%, well, anyone looking to buy your bond will want a discount to make it worth their while. Well, that discount is the price falling. So why would someone actually choose to invest in bonds? Well, there are three main reasons. And the first is stability. Because bond prices move more steadily and predictably than shares, they can bring a sense of balance to a portfolio, particularly for investors who are closer to needing their money or who simply can't stomach sharp swings in value. The second is income. Bonds pay interest at regular intervals, and that income tends to be more dependable than dividends from shares, which companies can cut or cancel whenever they want. This makes bonds particularly attractive to anyone looking for a reliable income stream, like, for example, those approaching or already in retirement. But perhaps the most important reason is diversification. Bonds tend to behave differently from shares, and as we saw earlier on that chart, sitting in a different part of the risk-return spectrum means they often move in different directions too. When stock markets are turbulent, bonds can act as a cushion, which explains why spreading your money across different asset classes is one of the most effective ways to manage overall risk in a portfolio. In fact, this is exactly why professionally managed portfolios, like the ones Moneyfarm builds for its clients, typically hold a mix of both shares and bonds, with the balance adjusted depending on your risk profile and how long you're investing for. So if you're investing more cautiously, bonds will play a bigger role, whereas if you're comfortable with more risk and have a longer time horizon, the balance will shift towards shares. Okay, let's say you're convinced to invest a part of your money in bonds. How should you go about doing it? Well, there are two main routes. You can buy individual bonds, or you can go for a bond fund. Buying individual bonds directly on the market gives you more control over exactly what you own, but it also comes with some real practical challenges. Minimum investment amounts can be high, sometimes thousands of pounds per bond. And if you want decent diversification across different countries and maturities, you're likely looking at a significant sum just to get started. For corporate bonds in particular, the most attractive issues often have minimum investment amounts that put them completely out of reach for most everyday investors. Therefore, most people tend to go through the second route. They invest through a bond fund. With a bond fund, a single investment gives you exposure to many bonds at once, sometimes hundreds or even thousands, and you can typically start with smaller amounts. Let's take a closer look at funds. You get a choice of active or passive funds. Active bond funds have a fund manager or team of managers responsible for researching and choosing investments for the fund, with the aim of outperforming the market or managing the fund in a certain way. Passive bond funds, on the other hand, track a bond index, aiming to replicate its performance rather than outperforming. They're usually cheaper than active funds because you're not paying for the manager's bond picking skills. Beyond these investing styles, you can also invest in bond funds focused on government bonds, corporate bonds, investment grade or high yield bonds, certain duration bonds, for example, short or medium term bonds, both corporate and government bonds from around the world, and more. And you can also invest in funds that have a mix of bonds and other investments. The practical good news is that it's straightforward to access bond funds through investment platforms like Moneyfarm, including Insider Stocks and Shares ISA or a SIP, so your returns can grow free from capital gains tax and income tax at the same time. Well, there you have it. Everything you need to know about investing in bonds. If you found this video useful, please subscribe to the channel and have a look at the description below for more information on Moneyfarm. And as always, I look forward to seeing you in the next video. Bye bye for now.